We've just held Argo Investments 2024 Annual General Meeting, and I'm joined now by our Managing Director, Jason Beddow, who's going to discuss some of the topics from our AGM, including our current view of the market and the outlook. First, Jason, I wanted to ask you a question more specific to Argo. For several months, Argo has been trading at a discount. Its share price has been trading at a discount to its net tangible assets. Its NTA is currently around a 10% discount currently. Is this a structural or a cyclical trend, and what are the factors impacting it?
Hi Meredith, thank you. Yeah, it was a good AGM today. We had quite a good turnout. And yes, I think the LIC share price discount to NTA is topical for the whole sector. Look, Argo's got the benefit, I guess, of a lot of history, and we think it's cyclical. Two main factors that we've got, at least data we can relate to, is interest rates. The rapid escalation in interest rates. Clearly investors can get a fairly good risk-free return of circa 5% in cash. So there's a bit of an unwind of what we saw investors doing during the COVID crisis when interest rates were very low. The second thing is, the markets are at an all-time high. Argo has a relatively conservative portfolio, and we have data month by month for 20, 30 years. Generally speaking, if the market's running really hard, our NTA will lag a little bit, and also the share price will lag the NTA. Conversely, in down months, our NTA performs better and the share price much better. And not saying we're reaching that point, let's hope not, but the first tech boom, the GFC, Argo was at quite big discounts. These events happened and Argo went to a very big premium very shortly. So, we look at the data and the number of up months, which we're having. So look, it's not a huge surprise to us. Clearly we like to trade around NTA. Luckily, over 30 years, our average is in line with NTA, but clearly, and we had a chart today showing that the short-term dispersion can be quite high. We can trade at 10 to 15% premium, equally 10 to 15% discount.
And we were just asked a question at the AGM about ETFs and the relative appeal of an index ETF to Argo. And I was wondering if you could explain a bit about how they stack up against each other.
Yeah, sure. And different investors have different, objectives. One thing that I guess Argo is a company. So the company structure is quite different to a trust structure. One thing that we think is a benefit for those looking for dividends and fully franked dividends is that we have the ability, one, we pay our own tax, we generate our own franking credits, and we can smooth our dividend through cycles. So we can maintain and grow a fully franked dividend over time. An index ETF is at the vagrancies of the market and the index. Now, we saw probably the most pronounced example of that during COVID when the index dividend was slashed by 40, 45% as a lot of companies stopped paying dividends, earnings collapsed, and the level of franking. That's bounced back somewhat. But we can sort of alleviate that. So if you're looking for fully franked dividends, for something that's probably a comparable cost, we think it stacks up relatively well. The benefit of the fully franked dividend over the index, it's arguably 30 to 40 basis points a year, which, is a value that we don't sort of ascribe, even though we do talk about the value of grossed up dividends. So they're probably the biggest difference. There's a lot of other nuances. We think our cost is, comparable, is slightly more than an index ETF, but far lower than most managed products, which are, multiple percents or with performance fees. And we think, over time, as long as we can be there or thereabouts the index, an ETF by definition will be index minus a little bit of cost. We think the proposition stacks up.
Turning to the markets now, and obviously one of the biggest factors influencing investors is interest rates. Last month, the US Federal Reserve, the world's biggest economy, they cut interest rates by a larger than expected 50 basis points. Other central banks have already started easing as well, or expected to imminently, but not the Reserve Bank of Australia. What's your outlook for domestic interest rates?
Look, we think, short term, say next 6 months, there's probably, no outcome from the RBA, as in no change in interest rates. Twofold, the economy's still running pretty well. The economy's growing, unemployment's still relatively low. Not to say there's not some challenges out there, but statistically, things don't look too bad. Equally, the RBA never went as high as some of these economies. So the US has cut 50 basis points, but it's actually still meaningfully higher than where our interest rates are at 4.35. So we think, I guess, and paraphrasing the RBA a little bit, they didn't go as high, so they've probably got to stay higher a bit longer to get the same impact. So look, inflation is trending back down, but, still above the range. So we think, look, we'll get into 2025. We'll be post the US election, which may or may not have implications for China and the world and by default the Australian economy, and see what happens. But we'd expect them to be flat for at least the next 6 months.
We'll come to the US economy shortly, but just on China, Australia's largest trading partner, and the health of its economy looms large over Australia's share market. The government there recently announced some stimulus. Do you think this will be enough to drag the Chinese economy out of the doldrums?
Look, it's a tough question to answer. A lot of the heavy commodity demand that China's done over the last 20 years, a lot of this stimulus doesn't really address that, as in prime commodity demand. So they're not going to buy and build a huge number of apartments and have in real estate 25% of the economy again. There's some consumer stimulus, there's some support for the housing market, there's support for the stock market. I think the overlay is, I guess, if the Chinese consumer is a bit more confident and they're spending, that will be good for the Chinese economy generally and will be good for commodity demand. But I don't think it's the big boom we got back in, say, 2010, when China sort of was reacting to the GFC and they had a huge amount of stimulus, and Australia's GFC experience was quite short because of that. So I think maybe the worst is behind the sentiment towards China, but I don't think investors are banking that this is going to turn things around and China's off to the races again. So it's still, I think, a tricky time the next few months. And I guess, again, segueing into the US election, there could be some different outcomes on, at least at a headline level, tariffs and impacts on the Chinese economy. So there may be more to come.
Okay, and coming back home, and the big four Australian banks have had a pretty stellar run. One in particular, Commonwealth Bank. Can you explain the performance of Commonwealth Bank relative to the other banks?
Look, I wish I could. I wish it was as easy as that. Look, CBA is the biggest bank. It's the biggest franchise, has the biggest deposit book, and clearly that deposit book is a huge source of income for the bank, and it's a great funding. I guess from a historical perspective, CBA hasn't had to raise equity at a discount through any, let's say, mishaps or things they've done along the way. So the other banks have all ventured offshore at various times into different businesses, have all had to raise money, which dilutes their returns. CBA hasn't had that experience. So, its returns, ROE and things like that are superior to the other banks. The current environment, though, it's pretty competitive. The mortgage brokers have a significant sort of position in the market for new mortgages. I think people with interest rates higher are a bit more sensitive on what rates they will pay. So, it's hard to sort of say, CBA has a significant competitive advantage, today when they're signing a new mortgage, for example. But from a historical perspective, the franchise they have and the market share does give them, some tailwinds, I think. But, I don't think anyone thought CBA would hit $145. It's nearly 10% of the index. And by all traditional metrics, CBA is pretty expensive.
Market watchers can point to various different indicators that paint a pretty bleak picture. We've got still sticky inflation, high interest rates, struggling consumers because of the higher costs of living, and a subdued Chinese economy. But Australia's share market keeps hitting record highs. Can you explain why this is?
Look, I think it's not just Australia. I mean, I think most Western economies, global stock markets are at all-time highs, pretty much across the board. Some of it comes back to the earlier comment. I mean, the US Fed's cut rates. Most other Western economies are cutting rates. Australia is unlikely to put up rates, so the next move will be down. But we're starting at a point where the economy is still in good shape and unemployment is not. So often, by the time the Fed's cutting rates, the US is almost in recession. Unemployment's rising aggressively. The economy, is going backwards. We're starting at a very different point now. So the economy is pretty strong. Unemployment's not too bad, and we're cutting rates to further stimulate the economy. So, I think that's sort of some of the excitement around investing in markets. And it's also, I guess, a relative that there was a lot of money printed during the COVID crisis globally. And, as we're still seeing, this money is still finding a home, looking for a return, and, moving into equities.
And turning now to the outlook, we've seen that strong share price performance drive PE expansion. Are we going to see an increase in earnings and dividends, do you think, going forward?
Look, at some point in time, I think we need to sustain the PE expansion. And it's a little bit nuanced. I mean, in some ways, the US market has been driven by the large cap tech stocks, and they are growing earnings. So you look at the US market and the earnings outlook, and they're material. You look at the Australian market that has a far less exposure to technology, much more cyclical, or a bigger share of the market is in cyclical resource stocks, which are probably still come downgrade. So that has a bit of a meaningful drag. So I think if you look, say, take consensus, there's a little bit of earnings in the banks the next year or two. Industrials are probably okay, but again, we're talking mid-single digits, nothing particularly exciting, and resource stocks, probably still down. So, I think we probably need to see some earnings. I'm not sure where it comes from in the economy. If you look at the mix of the Australian economy and the makeup, where you get a meaningful kick, potentially, I guess, some interest rate relief. Even though it's at the margin and most companies have good balance sheets, that still means, below the line, below the EBIT line, interest will come down, so NPAT gets a little bit of acceleration. We'll see. But I think at the moment, the US keeps going up and global markets continue to follow.
And speaking of the US, and it's hard not to discuss the US election when you're looking at the near-term outlook for equities, both abroad and obviously and in Australia too. What's your outlook for the US election?
Well, actually, the AGM today, I had a look at what the bookies were saying, because I think they've been, over the last 10 years, much more accurate than the polls. At the moment, I guess Donald Trump is firming with the bookies, not to say that he will. One thing, I guess, with having a change of Democrat, though, is that it's unlikely that there'll be a clean sweep. So Congress or the parties will be mixed. Probably means the impact is not quite as... So damaging is probably the wrong word, but there could be some big policy changes if either party was to have both houses. I personally think that, with all the stimulus that's being spent in the US and Australia, fiscally, governments are spending a lot of money, that I think once the election's resolved by either party, that it's probably positive for the US, and we may still see a further rally.
And what are the other factors that you're seeing that are shaping the outlook currently for Australian equities and more broadly overseas?
Yeah, Australia's a little different. I guess the mix of the market, I guess we've got a lot of government intervention, a lot of regulatory sort of oversight, both at certain industries, but just through industrial relations with human resources. And that's making it tough for some companies. So, I think some companies are holding back on capital or making that next big decision. Offshore, a little bit similar. I mean, governments really have stepped in and are fiscally spending, across Europe, across the US, and they don't seem to be too worried about their balance sheets. I mean, all these governments are spending, they've all got massive deficits. They're probably reaching all-time debt to GDP levels. But unlike a corporate that gets reined in by boards or shareholders who has to get a return, they continue to spend. And I think that's filling a real hole in the economy. So economies stay strong, markets probably stay relatively strong, particularly if inflation doesn't bounce back and we get a little bit of interest rate support.
Great. Thanks very much, Jason. And thanks very much to all our shareholders who joined us today for our AGM in Adelaide. And we look forward to seeing you on our roadshow next May.